Good evening, everyone. It's FOMC day today and great moment to basically do a little bit of research and building our skills and our tools while we are patiently waiting for Jay Powell to tell us what's next. Today, we are going to talk about how we build confidence into those probabilities, also reiterate what they mean, and how do we end up using them to structure a trade and make sure we are aware of the main drivers in particular that are behind those probabilities. So as usual, this is the main page where you usually want to start looking for trades. So right now at the moment, I have a trade in Moderna. The realized volatility is high, but implied is even higher. So the VRP right now in GME is about 27.5, right? And we're saying the likelihood that the implied volatility you would sell today at roughly 30 DTs in GME is likely to exceed the subsequent realized volatility that we will observe. So right now, you can sell something like 62.2 from an implied volatility, and the realized volatility is at 34.7, right? So you have quite a bit of margin. It doesn't seem too far-fetched to think that if you sell 62.2 right now, you would need something pretty drastic to eat all of that margin, right? But we never know what's going to happen in the future. This is basically backward looking. It really compares these two numbers. And this is forward looking. It allows you to think about that number, 62.2, and say, okay, we're thinking that realized volatility is going to be underneath that level. So it's the same idea for Moderna. 60% chance that the IV you sell today, so 61.8, is going to be higher than what we will realize over the next 40 days. So the forecast is quite powerful, and obviously having the margin, the current level of the VRP next to it is also useful. So now how do we build confidence into those numbers? First and foremost, you have those little pieces of text here that are AI generated, and that gives you an idea of what that number means and some of the key drivers that explain forecast from probability perspective. Now, if you don't want to read that text, I understand. You may want to go directly into the analysis page for Moderna, right? So you basically just have to click on the ticker. That brings you to that broader analysis page where here you will see the text that you were seeing right here, right? That's the same bit of text that is right there with the same explanations. It's not the most readable. We can probably do something about it to make it a little bit more digestible. But essentially, you have pretty much everything you need in that bit of text. You have pretty much everything you need in the analysis page, and starting with the key drivers. In that case, we're saying one of the key important drivers that makes us think implied volatility is going to be above realized volatility over the next 30 days is because we think the VRP at 1 month is pretty high, right? The Z-score is about 2, and overall that has a medium impact on the way we think that probability. So we do not show all the different drivers for our predictions. We only show those that have at least a medium impact. So what we mean by medium impact is that the model is fairly sure that this is relevant in the prediction. There's a bunch of features we compute and we maintain every single day to make our predictions. Not all of them are relevant, but sometimes it's a combination of very small features with one another that are going to drive a prediction one way or another. And sometimes just one feature, especially feature that are relevant in that use case, are going to tilt the balance quite significantly. And here in Moderna, it's a great example. So at that stage, the stuff I would do is probably put things into perspective, right? It looks like, first of all, the model has been screaming that the probability to sell the VRP has been good for about really a week now. I think we put that trade somewhere Thursday or Friday next week. I don't exactly remember, but I keep the position for about 2 weeks, so we can check. We'll check in the Discord when times come. But then the other thing I want to look into is the term structure. I want to go have a look at about 30 days, and indeed it looks like there is quite a bit of VRP right there. When we do Z-score it, we will see once in a while those slight differences. I need to make a better video to explain where those slight differences comes from. This is because we compute VRP with fixed interpolated volatility, right? So every single day I have a value, while for 31 days, I do not have a value every single day. It's a weekly contract in Moderna. So I have a 31 DT contract every 7 days, but the idea is the same. It's pretty stretched, 174 to, you get the idea right now. If you sell around here, you sell something pretty expensive. And the model picked that as one of the key reasons why you want to be on the short vol side. Now, what about the other element that we score? Because we do not just have a probability for VRP, we have a probability for realized volatility, for implied volatility, for the skew and slope. So the realized volatility here, we're basically saying it has 92% chance to go up. I insist on this one. It doesn't mean it's going to explode. We're just simply saying that level here of 40.85, we are going to be above that within 2 weeks. And that is enough to structure some trades. If you think that realized volatility at 30 days is going to go up, well, you don't necessarily have to trade exactly that contract. You might want to give yourself a little bit of space, maybe look into this one, 38 DTs, maybe 45 DTs, because you want to avoid any nasty surprise on the realized volatility side. Once again, it's not a prediction of magnitude, so we're not saying for sure that stuff's going to explode. We're just saying it's low right now, it may go up. You can actually switch charts within the analysis page here. So you can always come and look at Moderna and being like, indeed, it seems like we are in almost the lowest level we've seen so far in the stock. Looks like also we've been gradually going up over the last few days. So it's not far-fetched to think that we are going to go a little bit higher up. Now, is it going to be enough to challenge IV you sell today? Probably not. You have other explanation as to why we think implied is expected to go down. Not as strong, right? 60%. I start to pay attention to probabilities when they're above 65%. 60%, okay, let's just have a look at it. We're still very far from the earnings, 44 days. We're not expecting much more from, big hands, people that need to edge ahead of earnings. And we also see the 1 month implied volatility is quite high. If you just look at implied to take decision whether or not you should sell it, that's not a good idea. You should always put it in the perspective of realized volatility. But once you are inside that framework, that's really how you want to go from the VRP in here, the VRP table, and then try to build a little bit more confidence into the trades that you pick. We are right before FOMC. Let's try to see if there are a few stuff that we want to pay attention to. I think KRE is a good one. Here, that's a very solid signal. It's basically saying that the Z-score in the VRP in KRE is quite pronounced. This should give us a lot of confidence in that prediction. What does it say about realized? It says that realized volatility should go up because we are quite far from the next CPI. Interesting. But more interestingly, it basically picks up that implied at 9 days being high is likely to trigger some boot of realized volatility. That kind of makes sense. The market doesn't buy implied volatility for no reason. So if you see implied volatility going high, that's because the market is expecting something to happen. And that's also the reason why you always want to put IV in the context of RV. FOMC is tonight. That still has an impact on the very short dated part of the curve. It basically tells you that, like, hey, if you have so much VRP right now, the market is potentially expecting something. So you should be ready to see that number go up over the next few days. And we do think reasonably that implied volatility is going to go down. And we do think this because right now the level of implied volatility is elevated. Let's see if we can look into one of my favorites. What do we have for VXX? We have a VRP that's stretched, especially in the front part of the curve. We'll go have a look at that in a second. And same for the overall level of implied volatility. So this gives a lot of confidence. We still expect realized to go up. That makes sense. You have basically a very strong probability to see the VRP not fully realized over the next 9 days. But at the same time, you've had such low level of realized volatility that the market is able to pick up on the fact that VRP's tense upside realized vol has been very quiet. So upside realized vol, if you think about it, so it's realized volatility that is computed using only the upside returns. And basically the model is picking up on the fact that the VRP is quite high. We haven't had a spike in VXX recently. It is likely that something is going to happen. That's for 9 days, right? We make prediction for 9 days and then 30 days. At 30 days, we might have a very complete different opinion. In fact, at 30 days, we don't have any meaningful driver to show to you guys. Why is that? Why do we still have a strong prediction then? Because overall, the hedge in VXX is so pronounced that sometimes you don't need. That's what the model is picking up on, right? Like the carry of being short vol in VXX is so pronounced that the likelihood that IV is going to be above RV over the next 30 days is quite high. There's no very strong particular reason to highlight, but yeah, overall, that's usually a good trade. And then for the reason why we think RV is going to go up, well, we still have the usual suspect implied vol at 9 days is high. We're expecting something in the short term. The realized vol term structure. So this one is also an interesting one. So basically, that's the same term structure than the implied volatility term structure. We don't show it in the dashboard, but basically what we're saying is the short term has been extremely quiet, right? So you have something that is quite pronounced from a contango perspective, and it's likely that at 9 days something is going to happen so that contango become a little bit less pronounced. So that's an interesting feature. So ultimately, if something's going to happen over the next 2-3 days in the market, potentially, at least those are the different elements that we are looking into. And ultimately, you want to use that to guide your decisions and decide how you are going to structure your trades. Let's go to see the vol surface in VXX. So as you would expect, you have that core skew usually in VXX. People love to buy calls. They tend to sell puts or not buy puts that much. Implied volatility is nothing else than a measure of supply and demand. The reason why you have a very low number here is because people don't want to buy this. The reason why you have a very high number here is because everyone wants to buy stuff. So the skew is severely unbalanced. You have almost a ratio of 2 to the money here at 14 days and 0.73 here to the money. And ultimately what we were saying before is 9 days, we thought that selling implied volatility in VXX did make sense. And it's interesting because even the puts are quite expensive at 10 days right now. So they're obviously not as expensive as like a 20 delta calls or a 30 delta calls. But if you come and sell a 20 delta stronghold right now, or maybe just simply an at the money straddle if you don't want to overcomplicate things in VXX at about 10-14 days, you're basically in great shape, right? Here we were saying in the analysis page at 9 days, we're pretty confident that realize isn't going to exceed implied. If you come at the vol surface, you can see that your VRP stretch in the front part of the curve. And even if you come here, you probably have a little bit of meat to extract out of that volatility surface. So that's about it, guys. Thanks for tuning in. If you have any questions, as usual, leave them in the comment or in the Substack. You know where to find me, and I will be happy to answer everything. See you around.